Hey dreamers, I've been dreaming a lot lately about that $100,000 I need and also how to cover all of my expenses as soon as possible. It actually led me down a rabbit hole of researching a strategy that would allow me to use my tax sheltered money without incurring that 10% fee prior to age 59 and a half. I always think these kinds of strategies are super interesting because it might help you plan ahead in terms of numbers of years you need to work, or if you're closer to retirement, it might even be the answer to quitting before you thought you could. So today I'll show you what I've discovered about this little known retirement cheat. And at the end, I'll tell you what I'm dreaming of doing. So what is it? It's Rule 72T. Rule 72T allows penalty-free withdrawals from IRA accounts and other tax-advantaged retirement accounts like 401k and 403b plans. And essentially, it's a tax cheat between you and the IRS because it means that the IRS will not charge that 10% penalty. Now, the IRS still subjects the withdrawals to the account holder's normal income tax rate, just not the 10% penalty for early distribution. Essentially, to take advantage of the rule, you have to withdraw SEPs, substantially equal periodic payments. And this is quite a commitment because once you start withdrawing the funds, you have to continue to that payment schedule for 5 years or until you reach age 59 and a half, whichever comes later. So there's a few different ways that this can be calculated, a few different methods. There's the amortization method, the minimum distribution method, and the annuitization method. My understanding is that the amortization method gives you the highest amount. Now, I recently was in my Fidelity account and I noticed something interesting. Under the Planning and Advice tab, you can click on Retirement. And when you click on Retirement, you end on this page. If you scroll down, you will see a link under the Retirement Resources that says View All Retirement Calculators and Tools. And if you select that and scroll down, at the very bottom of this page, you'll see this link, Substantially Equal Periodic Payments 72T Calculator. This is an interesting tool to get a sense of what kind of payout you might get. So when you select that, you get the 72T SEP calculator. And here you can put in your information of your date of birth, account balance, and annual interest rate assumption. My understanding is that this tool only allows you to put in a maximum of 3.01%, but there's a potential to use up to 5%. But for this example, let's go ahead and use the maximum that this tool allows. So in my case, my non-taxable accounts, the tax-deferred accounts, have approximately $800,000. And using this tool with a yearly distribution frequency, you can see the different amounts that the 3 different calculation methods produce, which gives a sense of how much money you could be taking out of the account without that 10% penalty prior to retirement. So this Forbes article goes into a little more detail in terms of how the 3 calculations differ. With the minimum distribution method, it yields the lowest possible withdrawal requirement of all 3. Essentially, you divide your account balance by the number of years the IRS currently expects someone of your age to live, and the resulting figure is the amount you must withdraw in 1 year of your SEPP. This amount is recalculated for each of the 5 years, giving you a different minimum distribution each year. Now, if you use the amortization method, this would calculate a fixed SEPP payment with no need to recalculate distributions each year. To determine the amortization payment, you pick the life expectancy factor and the federal midterm rate. And last, the annuity method, it works by factoring your total account balance, an annuity factor given to you by the IRS, the federal midterm rate, and the life expectancy of the owner of the account. Now, one question I've had is, once you start taking distributions, can you contribute again? And the answer to that is yes and no. You cannot make additional contributions to the account that you have set up the SEPP withdrawal on. However, if you have different IRA or retirement accounts that are not included in that withdrawal, you can contribute to those accounts. And there are different articles with strategies of how to think about that, like this one. For example, if you only have one IRA and you're currently taking a series of substantial equal payments from it, you can't contribute to it, but you could simply open a second IRA account. And once you've opened that second account, you can fund it with annual contributions. You're still prohibited from adding to or subtracting from the first IRA where you are using the distributions, but you can go ahead and contribute to that brand new IRA. Let me show you using my information as an example. So I promised to tell you about what I've been dreaming about with regard to this 72T rule. And using my round numbers, here it is. So as you know, I have two accounts that are taxable, one in my TD and one in my Fidelity. And roughly they kick off $23,000 and $20,000 in dividend annual income. Now my retirement accounts have three separate accounts. But from the IRS's perspective, that's just $800,000 worth of retirement accounts. And we saw in that earlier calculation around $35,000 that would need to be taken out in terms of the substantially equal periodic payments. But currently, I kick off dividend income of $32,000 from that $800,000, giving me a total dividend income of around $75,000 right now. So when I look at something like this, I think it wouldn't be that difficult for me to optimize these investments to match the SEP amount that would be needed to be withdrawn every year. So I started thinking to myself, could I actually start using my total dividend income to cover my expenses without that 10% penalty way before retirement? Now I know we're all looking at 59.5 as the finish line officially, but what if you accumulated enough investments where you could use this cheat to essentially retire well before? Now, I don't know how old you guys are, but I'm just in my 40s. So it's starting to make me wonder, if I start nearing that $100,000 mark and I want to pull the plug early, this could be a strategy that gets me to that goal. And what's interesting is that you could decide to just pick one account and have substantially equal periodic payments from that one account while continuing to allow yourself to contribute to another account. In fact, I learned that you could actually combine two accounts or three accounts or multiple accounts in Fidelity and then calculate your SEPP from that new combined one account while also leaving an additional account open for you to continue to contribute to. So there's lots of different strategies to think about. Now, let's say you're watching this and you're 20 years old. Maybe this just helps you think about a strategy to shave off the last 2, 5, or maybe 10 years. But if you are in your 50s now and have a major health issue, family issue, or maybe even just career choice that you want to make, this could be a strategy to think about. Now, right now, I'm just playing around with the idea, but my next step would be to meet with a tax professional or an accountant to really understand what the options are in terms of this calculation. So that's really the next step in the process. So, what do you think? Obviously, you want to use this as a kind of final end of investing type of income strategy. But hey, if you're jonesing to get off the grid in that camper, it's kind of a cool exercise as you think about your long-term cash out plan once you reach the other side of the mountain. I often start with the end in mind as a way to focus my strategy and timelines. I hope you found this interesting. Thanks for spending time with me today, and the disclaimer, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.